think the market was looking for direction from the AQR, and I'm not sure it got it, frankly.
Hello and welcome. My name is Brian Caplen, editor of The Banker. We're presenting a masterclass with Lloyds Bank of the UK looking at funding solutions for a new era. I'm here with David Carmalt, who's the bank's Managing Director and Head of Financial Institutions Debt Capital Markets. And in this chapter, Chapter 3, we consider the impact of regulation and how regulation is affecting the funding and capital strategies of financial institutions. So David, we've just had a rather momentous event in the Eurozone area with this whole asset quality review. What is that going to mean for banks' funding from now on?
I think what we saw in the run-up to AQR was a significant amount of capital issuance in the prior 6 months as banks effectively tried to get into the window before AQR was released. Post-AQR, we expect issuance to continue into the year end, and 2015 looks like it's going to be a very strong year for capital issuance, both in AT1 format and Tier 2 format, as banks, especially continental European banks, continue to rebuild their balance sheet and reconstruct their capital bases for a new era. And
has it stabilised the market? Because obviously there has been doubts about the quality of the Eurozone banks. Mm-hmm. Now we're supposed to have drawn a line under it. Have we really done that?
It's a good question. Certainly the AQR produced results which obviously impacted some of the European banks. 25 or so were impacted and will need to go through capital raising exercises. Some banks fared worse than others. And in the UK, we certainly have the UK PRA stress tests, which are likely to be a little more stringent as we head into the year end as well. So the UK banks will need to tackle the PRA side of things as well. I think the market was looking for direction from the AQR, and I'm not sure it got it, frankly. I think what it has done, though, is just ensured that those issuers who are waiting on the sidelines, a number of the peripheral Europeans, for example, who are keen to get through the AQR to demonstrate to the market that there weren't any skeletons left in the cupboard, those issuers will be attempting to come back to the market before the end of the year. And that's not just in capital format, it's also in funding.
Okay. Now, for both UK and European banks, obviously Basel III is still the overall guiding measure. Mm-hmm. How much is that changing funding strategies, and how much is there still capital to be raised to get in line with Basel III?
I think CRD4 is the implementation of Basel III in Europe. And there's no doubt that the majority of the core European banks have made a very strong push towards getting their fully loaded capital numbers in the right place as they head into 2015. What we are seeing, though, is the emergence or hope to get a final definition around things like TLAC, which is total loss absorbing capital, which also includes the concept of bail-in.
All right. Yeah. So it's basically the regulators saying that you've got to have a loss-absorbing bit of capital that just gets wiped out in a crisis.
Exactly, and what that means in effect is that issuers will have to hold significantly more loss-absorbing capital than they would have had to do under Basel II.
All right. Now why does the name of this thing keep changing? Because it was TLAC and it's been GLAC and PLAC.
Yes, I think the regulators have obviously gone through a number of consultations, and obviously different jurisdictions will have very different focuses when it comes to how they see the implementation of the new regulations and the impact it'll have on their individual banks. So regulators are obviously trying to justify the end result and make it acceptable for each and every jurisdiction, and I think that's the difficulty they have.
Okay. Now in the UK we've got something rather special because we've got this ring fencing which is coming out of the whole Vickers Independent Commission on Banking. Mm-hmm. So how are banks going to prepare themselves for that?
There's obviously an awful lot of work that's been done at the UK banks who are affected by the ICB. The proposals by each bank need to go in by the middle of January, and then there will be a further consultation period where the regulator will come back and define what ring fencing means for each individual entity. And ring fencing for Lloyds, for example, will mean something very different from ring fencing for Barclays, who have a very significant investment bank, and it will mean something very different for the likes of RBS. So again, the regulator is trying to create a safer banking environment with institutions that are very different in their shape and construct. which is a difficulty in itself.
And do you think we'll see a replication of this kind of process, the ring fencing, in continental Europe?
Absolutely. There are already plans afoot to implement a ring fencing type strategy within the European banking sector.
Okay. All right, we'll come back and talk about how you can approach the regulation from a hedging point of view in just a minute.